Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy for ADCB Asset Management. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Since the Russian invasion of Ukraine, energy supply to Europe from Russia has been disrupted and turned unpredictable. One could see this as an act of retaliation by Russia against European sanctions. There are also other reasons, like the scheduled and unscheduled downtime of Nord Stream 1 pipeline that brings gas to Europe from Russia. For the context, Nord Stream 1 is the single biggest pipeline for gas from Russia to Europe and has the capacity to deliver 55 billion cubic meters of gas each year. While Europe has attempted to replace the Russian gas with other pipelines and liquefied natural gas, that may not be sufficient to meet the entire demand in the short term. As a result of this supply-side disruption, gas prices moved sharply to record high levels and left countries scrambling to buy non-Russian gas and shield consumers from soaring bills. Talking of demand, Europe is attempting to cut its energy demand by 15% and introduce measures on electricity prices. Energy ministers of the European Union countries are to hold an emergency meeting on 9th September, and the chief of the European Commission is expected to outline the Commission's idea on capping energy prices in a speech on 14th September. One other measure is a windfall tax on energy corporations. Italy has already introduced one, but any European Union-wide tax would need approval from all its member countries, which of course is a high bar for approval. While the gas storage levels have improved quite markedly over the recent weeks across the region, they may not last for exceedingly long given the recent complete halt of gas supply through the Nord Stream 1 pipeline. Moreover, an extreme winter might make things worse. As such, drought is already affecting hydroelectric and nuclear power generation. These developments might have severe economic, policy, and financial market implications for Europe and beyond. For the euro area and the United Kingdom, a recession now looks more likely. Elevated inflation and soaring gas prices squeeze the real incomes of households. This is happening at a time when central banks are engaged in a tough fight against inflation, exerting further pressure on consumption. Business sector is likely to be impacted by elevated and rising costs and energy rationing. As such, the export sectors are not able to reap the benefits of weaker European currencies as the production remains impaired due to the supply-side constraints. Yet, any recession is likely to be mild in our view. In the euro area, labour markets remain firm. In the UK, any additional fiscal support from the new Prime Minister, still elevated pandemic-era savings of the households, and strong labour market should cushion the blow from higher energy prices. In terms of the monetary policy, both the European Central Bank and the Bank of England are still engaged in a tough fight against inflation. Looking into 2023, a mild recession should slow down the inflation and thereby allow the central banks to be less hawkish. Turning to the fiscal policy, a more targeted easing could be needed across the continent. However, political risk events including UK Conservative Party leadership election and Italian general elections are likely to be the focus. Moreover, the coordinated effort of all members of the European Union might be needed to counter this energy emergency, and there might be risks around achieving this too. In terms of implications for financial markets, this weak near-term economic outlook for Europe reinforces our long-standing cross-asset underweight position in the region. We remain negative on the outlook for the euro and the pound sterling against the US dollar. In the European fixed income space, we remain neutral to sovereigns and the investment-grade corporate credit, but underweight the high-yield segment. Turning to equities, our underweight position in Europe excluding UK remains our high conviction call. Valuations for this segment are already cheap and are reflecting the bleak outlook to a considerable extent. However, for now, we remain cautious with a focus on potential downside risks. Elsewhere, within the region, we are overweight internationally exposed UK large caps and remain cautious on domestically oriented UK mid and small cap segments. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights.